Let me show you what $109 oil actually means for mortgage repayments. In 5 weeks, the price of oil rose 68%. It goes nearly vertical, $65 to $109 in 5 weeks. The IEA, the International Energy Agency, has called it the worst energy crisis in the history of the global oil market. Not the first of its decade, the worst ever. Two of the biggest global events of 2026 are happening simultaneously right now, and almost nobody in the Australian property media is connecting them properly to what's happening on your street. Trump's tariffs are reshaping global trade. Iran war has sent oil from $65 to $109 a barrel in 5 weeks and forced the RBA to hike the rates twice. Both of these forces are hitting Melbourne property at the same time, and here is what I'm about to show you in this video that might surprise you. Both these global forces are simultaneously hurting buyers and protecting the long-term value of existing homes. I will show you the data on that at the 17-minute mark, and it's going to change how you think about this market. First, the numbers, because I'm not going to make any of these claims without the data to back them up. Quick note, everything I share is general information only, not financial advice. Before I explain why, let me show you where Melbourne property actually is right now. Melbourne's median house price is $977,000 right now, just under $1 million, down 0.2% in March. It's not a crash, but the direction has changed. RBA cash rate is at 4.10% after 2 consecutive hikes in February and March. At the start of 2025, the rate was on its way down. They cut 3 times. Then the Iran war happened, oil spiked, inflation jumped to 3.7%, and the RBA reversed its course. Every single hike strips roughly $100,000 from a buyer's borrowing capacity. Brent crude $109 a barrel. In mid-Feb, it was $65. That 68% surge in 5 weeks is why your petrol is at $2.33 a litre, even after the government halved fuel excise on April 1st. Auction clearance rate at 57%, the lowest since January 2025. A healthy market is above 65%. At 57%, more properties are passing in than selling under the hammer. Buyers have leverage they didn't have a year ago. CPI 3.7% in February before the petrol shock hit. The RBA target is 2 to 3%. We are above it and climbing. 6 numbers. That's the picture. Now let me explain exactly what's driving it. The tariff story is more complicated than you have been told. And the key number, the one that connects Washington DC to your Melbourne auction, is not the one you would have expected. I'll show you what it is right now. Australia exports only 4.6% of its goods to US. So technically Trump's tariffs should barely catch us. And yet they are pushing up construction costs all over Melbourne. Let me show you the timeline that explains why. April 2025, Liberation Day. Trump announces sweeping tariffs across virtually every country. The effective US tariff rate jumped from 2.5% to 21%. Markets crashed. February 2026, the US Supreme Court strikes the Liberation Day tariffs down as exceeding presidential authority. Brief relief, but within days the administration reinstates a 10% blanket tariff under a different legal power, plus a 50% on steel and aluminum. The wall got rebuilt on new foundations. March 2026, the EU and Australia signed a free trade agreement covering 98% of goods, worth $10 billion annually to Australia. A genuine positive offset, but it doesn't cancel the construction cost impact. April 2026, just this week, 100% tariffs patented on pharmaceuticals. The escalation continues. Where does it end? Nobody knows. Now, here's the connection most people miss. The tariffs hit China, Japan, and South Korea hardest, 15% to 54%. Treasury estimates the indirect effect on Australia from those countries slowing down is 4 times bigger than the direct tariff effect on Australian exports to the US. Weaker Chinese demand for our iron ore, weaker Japanese demand for our LNG, that slows Australia's GDP growth. And slower GDP means less government tax revenue and less funding for the infrastructure that supports our growth corridors. But here is the property-specific chain. Watch these arrows. Tariffs hit, Australian dollar weakens, every ton of imported steel costs more, new homes build cost more, developers' margins collapse, they shelve projects, fewer new homes get built, existing stock becomes scarcer, the homes that already exist become more valuable. The tariffs are simultaneously hurting buyers and protecting existing property values. That's the paradox I mentioned at the start. And it's only going to get clearer when I show you the supply data in a few minutes. If the tariffs are at the freight train, the Iran war is the missile, and it's already hit. Let me show you what $109 oil actually means for mortgage repayments. In 5 weeks, the price of oil rose 68%. Look at this chart. You can see Brent crude sitting around $65 through early 2026, actually on the lower end of the recent ranges. Normal expected. Then you see 28 February, Operation Epic Fury, US and Israeli forces launched military operations against Iran's nuclear infrastructure. And watch what happens to the oil after that. It goes nearly vertical, $65 to $109 in 5 weeks. The IEA, the International Energy Agency, has called it the worst energy crisis in the history of the global oil market. Not the first of its decade, the worst ever. The Strait of Hormuz, the narrow channel between Iran and Oman, through which 20% of global oil flows, has been effectively closed. Vessel traffic dropped 94%. Every major shipping line suspended transits. Ships are being rerouted around the Cape of Good Hope, adding 10 to 14 days to every voyage and thousands of dollars per container. Australia imports 90% of its liquid fuel. We hold 36 days of petrol reserves. We are not insulated from this. Now here is where the Iran war directly hits your mortgage. Look at this rate chart carefully. Through 2024, cash rate held at 4.35%. Then in 2025, the RBA started cutting. February, May, August, 3 cuts, down to 3.60%. Property values bounced back. Everyone got excited. Banks were advertising lower rates. First home buyers came back to market. And then the Iran war happened, oil spike. Petrol hit record levels. Inflation re-accelerated to 3.7%. The RBA had no choice. February 2026, first hike in 2 years, back to 3.85%. March 2026, second consecutive hike, 4.10% in a 5-4 board vote, the narrowest possible margin. Even the RBA was torn. Now look at the Westpac forecast at the right end of this chart. They are calling for the cash rate to reach 4.85%, the highest since the global financial crisis, with no cuts until 2028. Every single rate hike strips roughly 100,000 from a typical buyer's borrowing capacity. Someone who could borrow 800K in mid-2025 can now borrow around 720K. That's real. That's happening to real people right now. The CPI chart shows you exactly why the RBA is stuck. The green band is the 2 to 3% target. Through most of 2025, inflation was coming down into the band. That's why they were cutting. Progress was being made. December 2025, inflation starts trending back. February 2026, CPI is at 3.7% and still measured before the petrol shock hit the data. The March and the April CPI readings, which will include the fuel spike, haven't been released yet. When they do, they are likely to come in even higher. The RBA government said it clearly in March. It will be much worse if inflation gets built into the fibers. They are hiking because they have to, not because they want to. So that's the global picture. Two forces, both negative for demand in the short term. But now let me show you what's actually happening in Melbourne, because some parts of this market are not following the script at all. We are halfway through this video and I haven't told you the most important thing yet. Here it is. Melbourne is not one market right now, it's two. And which half you are buying in makes an enormous difference to the decision you should be making. Look at this price chart. Houses on the blue line, units on the teal line. Through 2024 into 2025, both rising. Rate cuts were working. Houses touched just under $1 million at the late 2025 peak. Then see the red shaded zone on the right. That's the rate hike period. Houses are now at 977K, down 0.2% in March. Units 642K, broadly flat, showing more resilience because they sit at a lower price points within stamp duty thresholds. Here's the context. Melbourne house prices are still around 630K, cheaper than Sydney. That gap is structural undervaluation, and multiple economists, KPMG, ANZ, Domain, have identified Melbourne as trading below its historical price to income ratio. Auction clearance rates are the real-time heartbeat of market sentiment because 70% sellers are in control. Buyers are competing. Below 60% buyers have leverage. March 2025, 67.2%, healthy. November 2025, 72.3%, strong. And then January 2026, 63.4%, The first rate hike hit March 2026, 57.1%, the red bar. That's the lowest since January 2025. At 57%, more properties are passing in than selling under the hammer. Agents are going back to buyers post-auction. Vendors are negotiating for the right buyer with solid pre-approval and a long-term view. This is the moment. But this is the critical point. The 57% average is being dragged down by the upper end. Affordable outer suburbs still competing. I'll show you the suburb breakdown right now. Look at this chart. This is Melbourne's two-speed market. Frankston up 12.9% annually, Brimbank 10.3%, Sunbury 8.5%, Chasey, Dandenong, Kingston 6 to 8%. Every single one of these is an affordable outer or middle ring suburb where buyers can still find properties under 750k, the threshold for most first home buyers grants and concessions. Now look at the right side. Melbourne overall down 0.9%, inner city apartments down 2.1%, upper quartile properties above 1.5 million down 4.8%. The rate hikes are hitting hardest where borrowing capacity matters most, the expensive end. The affordable outer suburbs have a natural floor, both the grant thresholds that keep bringing FHBs in and the supply chain crunch I'm about to show you. I promised you at the start that I would show you why both global forces are simultaneously hurting buyers and protecting existing property values. Here's that proof. It's called the supply paradox, and it changes everything. Here it is. The same forces hurting buyer demand are destroying new housing supply. The supply problem is structurally more severe than the demand problem. Look at these two bars. Melbourne needs approximately 45,000 new homes per year to meet population growth rates. CBRE forecasts will build around 8,200 apartments per year against demand of 39,500. That's a shortfall of 31,300 apartments. Every single year, construction costs are up 40% since 2020. Trump's tariffs, 50% steel tariffs, is making this worse. The Iran war is pushing diesel for earth movers and cement trucks to record levels. And 1894 construction companies went insolvent nationally in the financial year to February, the highest any sector. 82,500 approved, shovel-ready sites fit stalled because the enabling infrastructure, roads, sewers, electrical substations isn't funded. UDIA forecasts a national housing check shortfall of 380k homes by 2030. Less new supply, more people. Melbourne grew by 105,000 people last year, the most of any Australian capital, equals structural upward pressure on rents and prices. That pressure doesn't go away when interest rates fall, it compounds. The short-term pain of rate hikes is fighting the long-term reality of housing shortage. And in the long run, the shortage always wins. Before I go ahead, real quick, nothing I say here is a financial advice. I'm a property media guy, not a licensed advisor. The data I'm sharing is publicly available and for general information only. Your situation is unique, so please get a proper independent advice. Okay, let's keep going. For the first home buyers, what does the data suggest? 1. Get your borrowing capacity reassessed right now. If you got a pre-approval 6 months ago, it may have been dropped by 60,000 to 80,000 because of the rate hikes. Last year's approval is not this year's approval. Go back to your broker. 2. Model your repayments at a 4.60 cash rate. That's where markets expect rates to land by end of year. Don't buy at your maximum borrowing capacity today. Model for the next potential hike. 3. The data supports first home buyer activity in the affordable outer and the middle ring. Frankston, Cranbourne, Pakenham, Brimbank, Sunbury, positive price growth are about 750k medians, metro tunnel connectivity grant eligible. 4. Units are outperforming houses right now at the affordable end. Melbourne units at 642k median under the full stamp duty exemption threshold if you find the right property. That's potential 31k saved on day one. 5. Don't wait for certainty. The buyers who do best in uncertain markets are the ones who move when the others hesitating. For investors, Melbourne is structurally undervalued against Sydney by 629k on median prices. Gross yield 3.7% is above the combined capital city average. Vacancy at 1.3% is firmly landlord territory. The Iran war fuel shock is creating a premium for rail-connected suburbs. Metro tunnel suburbs are the beneficiaries, and investors lending grew 31.8% year on year through December 2025. Smart money is already moving. Now, you have watched about 20 minutes of data. Here's the one sentence version. Trump's tariffs and the Iran war are creating short-term demand pain and long-term supply protection simultaneously. And Melbourne's affordable outer suburbs are sitting right in the eye of the storm, cushioned by population growth, infrastructure investment, and housing shortfall that isn't going away. The buyers who will look back in 5 years and feel great about their decisions are the ones who bought with clear data, not the headlines. In 2026, when others were hesitating. The full April 2026 research reports for Frankston, Cranbourne, and Pakenham, plus this macro analysis, all free on nexthouse.com.au. If this was useful, please subscribe, give it a like, share it with someone thinking about property right now. And please speak to a licensed professional before any decision. I'm Ankur. This is Next House. See you soon.